The market does not react to supply and demand zones simply because they exist. It reacts because buying and selling activity was strong enough to leave a meaningful footprint in that area. Learning how to identify those footprints is what transforms supply and demand from a basic concept into a practical trading framework. Welcome back to the Calm Lucro channel. In this video, we are going to break down 10 practical rules for identifying high-probability supply and demand zones using smart money concepts. Step by step, you will learn how to combine market structure, liquidity, inducement, multi-time frame analysis, optimal entry zones, and trade management into a complete process for finding and executing higher probability trades. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let us get started. Rule number 1 is the break of structure. To begin with, this rule is very simple and easy to understand. The zone must be responsible for a clear break in market structure. Let us see how this plays out on a real chart. Imagine the market is in an uptrend, with price consistently forming higher highs and higher lows. Now, pay close attention. Price pushes higher and breaks above the previous swing high. This movement represents a clear break of structure and signals strong buying pressure in the market. More importantly, it shows that buyers have generated enough momentum to overcome the previous resistance level and continue the trend. So, what do we do next? Instead of reacting immediately, we look back on the chart and identify where that impulsive move started. That origin point defines our demand zone. This is the area where buyers stepped in with enough strength to break market structure and initiate the expansion higher. But here is the most important part. We do not chase price. Instead, we remain patient and wait for price to return to that zone. When price comes back, we observe how it reacts. A strong demand zone does not guarantee an immediate trade, which is why confirmation remains important. If we see the right type of confirmation, that is our signal to enter the trade. And do not worry, we will explain exactly how to enter and which confirmations to look for in detail later on. Rule number 2 is the flip zone. A flip zone occurs when supply turns into demand, or when demand turns into supply. These zones are especially powerful because they often signal a meaningful shift in market sentiment and can lead to high probability trade setups. Let us move to the charts to see how this works. Imagine the market is in a downtrend, with supply clearly in control. Price breaks structure to the downside and forms a new supply zone. After that, price pulls back into this zone and attempts to continue lower, but it fails to break the previous low. This failure is an important clue because it suggests that sellers are beginning to lose control of the market. At that moment, demand starts to step in. Price changes direction, breaks structure to the upside, and continues moving higher. This shift shows that buyers have become strong enough to overcome the selling pressure that previously dominated the market. This is a textbook example of a flip zone. The key takeaway is to mark this area. What was once acting as supply has now flipped into a potential demand zone. If price returns to the zone and shows confirmation, it becomes a strong level to look for long trades. Patience matters here. Wait for a clear failure of supply, visible strength from demand, and confirmation that buyers remain in control before entering the trade. Rule number 3 focuses on sweep zones. Sweep zones are about identifying where large players are actively moving the market. Let us simplify the process. Price is trending higher, printing higher highs and higher lows. Then a pullback occurs and equal lows are formed. These levels are common areas where retail traders place their stop losses. As a result, they often become attractive liquidity targets for institutional traders. Price briefly moves below those lows, triggering the stops and releasing a wave of sell orders into the market. At first glance, this move may appear bearish, and convince many traders that the market is about to continue lower. But here is the key point. Price does not continue lower. Instead, it quickly reverses direction. The reason is that institutions are stepping in and using that liquidity to build large buy positions. The sweep provides access to the orders they need, while also trapping traders who entered in the wrong direction. Once price rallies upward and breaks the previous high, we have confirmation of strong demand. This break helps confirm that the sweep was not a genuine bearish move, but rather a liquidity event that preceded the continuation of the trend. At that point, we mark the zone and wait for price to come back. When price reacts there, that becomes our entry signal. Simple in concept, but extremely powerful in execution. Rule number 4 is inducement. Inducement is a classic move designed to trap traders into poor entries before larger players drive price in the opposite direction. Here is how this appears on a chart. Price is trending higher, forming higher highs and higher lows. After that, a small pullback develops, creating a minor low. Because the trend still appears bullish, many traders view this low as a logical place to hide their stop losses while looking for the next move higher. Price then dips slightly below the low, sweeps those stops, and immediately reverses with strong momentum. This is the inducement move. At first glance, it may look as though the market is breaking down and preparing to move lower. However, the move quickly fails, trapping traders who reacted too early to the apparent weakness. Why does this occur? Institutions need liquidity to fill large orders without causing excessive slippage. By pushing price into an area where many stop losses are resting, they gain access to the orders needed to build positions more efficiently. That is why price often reacts so aggressively after inducement. The key lesson is simple. We do not enter zones blindly. Instead, we wait to see if inducement takes place. When it does, the probability that the zone will hold increases significantly. Rather than reacting to the initial move, we allow the market to reveal its intentions and then look for confirmation before committing to the trade. Rule number 5 is stacking zones. Stacking zones refers to aligning zones across multiple time frames to identify stronger areas where institutional activity is more likely. The reason this concept is so powerful is that the more evidence supporting a zone, the more attention that area deserves. Let us look at a clear example. On the daily chart, we identify a demand zone where price initiated a strong upward move. Now, zoom into the 4-hour chart. Inside that daily zone, price creates another demand zone. This alignment forms a stack zone, which is a strong example of confluence. When zones overlap across multiple time frames, it often indicates a higher concentration of resting orders and stronger agreement between short-term and long-term market participants. Instead of relying on a single level, we now have multiple layers of support reinforcing the same area. As a result, price is more likely to react when it returns to that zone. This does not guarantee that the trade will work, but it increases the probability that the area will attract meaningful buying or selling interest. That is why stacked zones are often considered higher quality trading locations. This is where we patiently wait for confirmation and then look for a precise entry. By combining multiple time frames into a single area of interest, we can focus our attention on the zones that have the strongest overall market context behind them. Rule number 6 is higher time frame alignment. Higher time frame alignment is extremely powerful. When multiple time frames point in the same direction, your trades naturally carry a higher probability of success because you are trading with the broader market context rather than against it. Begin your analysis on a lower time frame, such as the M5 chart. At first glance, price may appear to offer a clean sell setup with clear lower highs and lower lows. Many traders stop their analysis there and immediately look for short positions. However, do not rush into the trade. Take a step back and zoom out to the M15 chart. You may notice that price has just tapped into a strong M15 demand zone that has not yet been broken. While the M5 chart appears bearish, the higher time frame may be showing that price is reacting from an important area where buyers could become active. At that point, the structure on M5 can suddenly begin to flip bullish. What initially looked like a continuation to the downside may actually be a pullback inside a larger bullish move. This is why analyzing only one time frame can sometimes lead traders into low probability setups. The lesson here is critical. Always respect the higher time frame. Lower time frames often provide the entry, but higher time frames provide the context. When lower and higher time frame setups align, you are no longer trading a single pattern. You are trading in harmony with the broader flow of capital and time behind the move. Rule number 7 is optimal entry zones. This is where precision becomes critical. Instead of entering trades randomly inside a zone, we want to focus on where pullbacks are most likely to end. To explain this properly, we're going to use a short concept taken from another video on the channel, where we break down the ICT trading model in detail. You will find the full video linked in the description. This model is known as ICT's Optimal Trading Zone and Optimal Trade Entry. It is a structured trade entry framework built around price swings, Fibonacci retracements, and market structure. The goal is to identify the most efficient area for entry, allowing traders to enter with precision instead of chasing price or reacting too late. One of the biggest challenges traders face is knowing where a pullback is likely to end. Entering too early can expose you to unnecessary drawdown, while entering too late often leads to poor risk-to-reward opportunities. The purpose of the optimal trading zone is to help solve that problem by identifying areas where price is more likely to resume the dominant trend. After a valid impulsive move breaks market structure, we apply the retracement tool to define the correction range. The optimal trading zone, typically located between the 61.8% and 78.6% levels, highlights areas where institutional participation is most likely to return in the direction of the dominant trend. Rather than chasing an already extended move, we allow price to retrace into an area where risk can be controlled more effectively and where the potential reward often becomes more attractive. This creates a more structured and disciplined approach to trade execution. By combining market direction, price swings, and optimal entry placement with concepts such as fair value gaps and multi-time frame confirmation, this model creates a clear and repeatable framework for high-probability trade entries. The more factors that align inside the optimal trading zone, the stronger the overall setup becomes. Rule number 8 is fresh versus mitigated zones. Fresh zones are areas that have not been touched, which usually leads to much stronger reactions when price returns. For example, a fresh supply zone is one that has never been traded into before. When price comes back for the first time, the reaction is often sharp and aggressive because the orders that created the original move are more likely to remain available in that area. Now compare that to a zone that has already been tested several times. Each time price revisits the zone, some of those orders may be filled or absorbed by the market. As a result, the zone can gradually lose its strength and become less effective over time. This is why the first return to a fresh zone is often considered the highest probability opportunity. The market has not yet consumed the liquidity and order flow that may still be resting there. In those cases where a zone has already been tested multiple times, the reaction tends to be smaller and weaker. That does not mean the zone cannot work, but it does mean traders should be more cautious and place greater emphasis on confirmation. The focus should always be on fresh, unmitigated zones, especially when they are combined with market structure, higher time frame context, and proper timing. When these factors align, the probability of a meaningful reaction increases significantly. Let us recap everything. The goal is to combine all 8 rules together: break of structure, flip zones, sweep zones, inducement, stacking zones, higher time frame alignment, well-priced zones, and fresh versus mitigated zones. The more of these factors that align around the same area, the stronger the overall setup becomes. Instead of relying on a single signal, we are building a complete framework that helps us identify where institutional activity is most likely to occur. When you apply these rules step by step, you can identify institutional supply and demand zones with the highest probability. However, finding a great zone is only part of the process. A strong zone alone does not guarantee a profitable trade. The way you enter, manage risk, and take profits is just as important. Always wait for confirmation. Stay patient, remain objective, and allow the market to reveal its intentions before committing to a position. This is how professional traders approach the market. Now let us move into trade management. This is the part that transforms a good setup into a winning trade. We will begin with entries, because the way you enter makes a major difference when trading around supply and demand zones. There are 3 reliable entry methods that you can use. First is the limit order entry. This approach is very straightforward. You place a buy limit at a demand zone or a sell limit at a supply zone. The main advantage is that you secure the best possible price. The drawback is that there is no confirmation, which means higher risk, but also the potential for higher reward. This method works best when the zone aligns with the higher time frame trend and shows a strong imbalance. In those situations, the probability of a meaningful reaction is often higher, making limit orders a practical choice for experienced traders who are comfortable entering without additional confirmation. Second is the change of character entry. This method provides confirmation before you commit to the trade. After price pulls back into your zone, wait for a clear shift in structure on the lower time frame. That shift becomes your signal. Once it appears, identify the high or low that caused the structural change and enter at that level. Your stop loss should be placed just beyond that structure. While this approach may sacrifice a slightly better entry price, it often reduces risk and increases the probability of a successful outcome. Third, and the most refined method, is the liquidity sweep combined with a structure shift. Here is how it works. Price takes out equal highs or equal lows, sweeping liquidity, and then quickly reverses. When that reversal breaks structure or creates a clear change of character, it confirms that institutions have entered the market. Rather than guessing where the move may begin, we are waiting for the market to reveal evidence that liquidity has been collected and that direction is beginning to shift. That moment is your cue to follow. They are effectively revealing where smart money is positioning itself. Now, let us move into stop-loss placement, because risk management is critical in trading. If you are using a limit order entry, place your stop just beyond the extreme of the zone. This allows the trade enough room to develop without exposing you to unnecessary risk. If you are entering with confirmation, such as a break of structure or a change of character, you can tighten your stop. Place it just below the low or above the high that caused the move. This approach keeps losses small and greatly improves your risk-to-reward profile. Next, let us cover take profits. Keep this part simple and structured. There are 3 solid approaches. First, target the next opposing zone. This is the next supply or demand area where price is likely to react. Second, use a fixed risk-to-reward ratio, such as 1:3 or 1:4. This helps maintain consistency and discipline over time, while removing much of the emotional decision-making process. Third, scale out of the position. Take partial profits early and allow the remainder of the trade to run. This locks in gains while still giving the position room to grow and participate in larger market moves. When you combine precise entries, proper stop-loss placement, and clear take-profit rules, you stop guessing and start trading like a professional. This is where discipline, risk management, and execution come together to transform strong setups into consistent results. Before we wrap this up, I want to share 2 additional rules inspired by insights taught by David Paul. These final rules are not about entries or zones. They focus on what determines whether a trader can stay in the game long enough for any strategy to work. Up to this point is position sizing and risk exposure. This rule is about how much you risk, not how good your setup looks. No matter how strong a trade appears, every setup carries uncertainty. That is why protecting capital must always come before pursuing profits. To illustrate why this matters so much, I am going to play a short clip where this concept is explained in a very direct and practical way.
In a 50% system, unfortunately, you get 2 bad ones every 4 trades. Ladies and gentlemen, if you were to bet 50% of your coins on any one trade, you go bankrupt every 4. Gets worse. 8 trades in a 50% system, you have a cluster of 3 bad ones in a row. That means, ladies and gentlemen, that if you were to bet a third of your coins on any one trade, you go bankrupt every 8. And most people go bankrupt because they bet far too much on any one single trade.
Position sizing is critical because losing trades are unavoidable, even with a solid system. The difference between traders who fail and traders who last is not the strategy, but how much damage a losing streak can cause. Every trading system experiences losses. What separates professional traders from struggling traders is their ability to survive those losses without allowing them to significantly damage their capital. When risk is kept small and consistent, no single trade can define your outcome, and no short losing streak can force you out of the game. And now, finally, rule number 10. This rule moves beyond risk and into decision-making itself. It is not about charts or structure, but about the mental state you bring to the market. Even with a strong strategy and proper risk management, traders can still make poor decisions when emotions begin to take control. Fear, impatience, frustration, and overconfidence can all interfere with the execution of an otherwise sound trading plan. To explain this properly, I'm going to play another short clip from David Paul that highlights why traders often act against their own rules.
We've got 2 brains. I'm sure you've all heard of the reptile brain and the front lobe brain. Well, I want you to think now, folks, that you're a summer's afternoon and the barbecue's going and kids are having fun playing football, right? And you're standing there. A ball comes out of nowhere. Football comes out of nowhere. What do? Duck. Yeah? Without thinking about it. A similar situation, but standing there Sunday afternoon and somebody throws a ball at you very slowly. What do? You catch it. Okay. So if somebody chucks a ball at you really fast, believe it or not, and according to this professor of psychology at UCT, there's a part of your brain that actually reacts, and it reacts up to half a second faster than your normal brain, this reptile brain, and its job is to keep you out of trouble. And frequently that happens in our trading as well, where have you ever done something dumb that you've sworn you'll never do again? Okay. And that's because that reptile brain is in fact trying to keep you away from danger. Not a lion about to hit you, but in fact emotional danger. And another example is that you're driving along a road and a dog comes out. Do you swerve? Yeah, you probably do. And you've said to yourself 1,000 times that I'll never swerve again. I'm going to drive straight. But in the moment, that reptile brain. So there's a part of you, if you're not present, folks, there's a part of you that's designed by the Almighty, or whoever you believe in, to keep you safe and well, away from physical danger, away from emotional danger. And if you're not present, you'll find that you keep doing really dumb things. So when you're sitting in your trading desk, it's really important that you're totally and utterly there. Not thinking about the past, not thinking about the future, totally in that moment.
Rule number 10 is presence and emotional control. Trading decisions are often made under pressure, and when awareness drops, reactions take over. That is when traders abandon their plans, hesitate, move stop losses, exit too early, or act impulsively. The reality is that most trading mistakes do not occur because traders lack knowledge. They occur because emotions interfere with decision-making at critical moments. The ability to remain present helps reduce that interference and allows traders to act according to their rules rather than their fears or impulses. When discipline, risk control, and psychological awareness work together, trading becomes structured, instead of emotional. This is what turns good analysis into consistent performance over time. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.